Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update. The week is August 12th, 2019. And so the market state, which we measure using the S&P 500, is currently in transitional market state 6. The Dow and the NASDAQ are also in market state 6, but if we look abroad, we can look at the EFA, which is again in a transitional market state 6, but really at the lower end of its trading range. And then looking at emerging markets, those are more bearish in market state 12. And so the current transitional environment that we're seeing in equities was really caused by a spike in volatility. So CVI had been declining and got as low as CVI 51 on the S&P 500, which is approaching those extreme low levels. And then it spiked last Monday as it needed to relieve some of that pent-up pressure, and now it's at its current point of CVI 70. So in this transitional market, the market's really trying to figure out where it wants to be, and it needs to regain its footing. So while it does that, we could expect to see some wide-ranging days or even some outliers for that time. And so all liquid traded securities are going to be driven by supply and demand. Supply and demand is one of the laws in the market. And so if we're looking at different asset classes right now, 20-year treasuries, or TLT, has been performing really well over the last couple months. But this really hasn't always been the case. Conventional wisdom is going to tell us that treasury bonds, or 20-year treasuries, are a safer asset class than equities. But if we look from July of 2016 through October of 2018, 20-year treasuries saw a minus 22% drawdown. I don't know what your definition of conservative is, but that really doesn't fit mine. In the meantime, small cap stocks, or the Russell 2000, saw a significant increase on declining volatility. Small cap stocks are always considered a riskier asset, but for that time they were more conservative than treasuries. If we fast forward 10 months, or from October 2018 through today, 20-year treasuries have seen low volatility and a significant increase, rising close to 20%. Whereas small cap stocks have seen a trading anomaly and a trading range and a high degree of volatility, and they're about 13% off of their October highs. So all those asset classes are going to have a time to own them and a time to not. And so if we're looking at a buy and hold strategy, you've done okay over the last couple of years for buy and hold, because when stocks have been, seeing high volatility and going down, bonds have kind of offset that by going up. And the opposite happens, where bonds experience, that bear market for that 2-year period. Stocks increase significantly offsetting that. What we know about, when a real bear market hits here is that when volatility is going to increase, securities are going to become highly correlated, and you're going to lose your benefit of diversification. So rather than seeing those offsetting penalties, we might see stocks and bonds become highly correlated. And so as volatility picks up, a buy and hold strategy's volatility is going to increase as well. And you could see a 35% drawdown like the conservative investors saw in 2008. And so conservative investors holding a buy and hold strategy are going to begin to wonder, why is my buy and hold not actually conservative? And so that's where adaptive portfolio strategy comes in. And so again, all liquid traded securities are going to experience both bull and bear markets. Equities have seen a little bit higher volatility and some outlier days recently, whereas bonds have seen a significant kind of parabolic increase. And just one note on that, they're now close to the point they were back in 2016, which is kind of some overhead resistance. So from this point, you might see a pullback in bonds, which the thermostat would adjust to accordingly. And so adaptive portfolio strategy is about buying securities that are showing bullish characteristics for the current market environment, and then combining them in a way that gives them a high degree of benefit of diversification. So that volatility does increase, your portfolio's holdings are not highly correlated, so you don't experience the spikes in volatility necessarily that the market might. And so when you buy these bullish securities, you don't know how long those correct characteristics are going to stay in place. It could be a week, or it could be a year, because we do not know how long or how far up the securities will go. But what we do know are the risks, because in order to achieve the benefit of long-term compounding, we have to limit the downside so we can compound on the upside. So it's about holding those bullish characteristics and maintaining an efficient portfolio for the current market environment. Thank you, and I hope you have a great week.